welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Alex Duys from Umthombo Wealth and Nick Crail from FNB Wealth and Investments. If you'd like to send questions, please email stockwatch@bdtv.co.za or SMS 41392. Nick, Alex, good evening to you both. Nick, if I may start with you tonight. Not a great day on the market today. The overall closed down 0.8% on the All-Share Index. And Sasol, I suppose, was one of the contributors to that decline, but it didn't close as badly as it started. It was down about 6% this morning and ended only 2% weaker. Why do you think there was a bit of a recovery? Because the numbers weren't great.
Well, because it's cheap. It's it's all about the starting point, I suppose. And if you have a look at the relative performance of Sasol relative to other, let's say, global oil kind of companies, it's been decimated over the last 18 months, and it is cheap. The question is that a value or is that a value trap? And I think that's certainly what investors are grappling with. You have it in your portfolio, you're hesitant to sell it at these levels. You're hoping for some sort of bounce, and then maybe you're going to sell it. And if you don't hold it, you're probably not too interested in holding it, to be honest.
Yeah, Alex, where do you stand on whether it's cheap or could get cheaper? I suppose maybe, well, that's the question ultimately.
Yeah, I could go with Nick. I think also if you think from a global ESG type of investor perspective, the demand for, let's call it oil stocks or chemical stocks, are perhaps less than the past. And if you are going to consider one, it has to be one that's got strong balance sheet and high dividends. And Sasol doesn't have that either. So that's a problem. Even though they paid a dividend in this set of results, they probably can't afford to pay anything. But they can't really afford not to pay. So they're a bit of a catch-22 situation as well as Sasol. For me, Sasol always promises, never delivers, and has always got some sort of cost restructuring program in place and so forth. The business is unfortunately, in a very difficult situation and will require exceptionally hard work from management to try to get back the price right trajectory, unless of course it's bailed out by high prices, high oil and chemical prices. But if oil and chemical prices remain as they is, I don't find it particularly compelling in the moment.
Yeah, and I think chemicals prices are going to remain where they are. When I had an interview with Fleetwood earlier this year, they said their outlook is quite bearish for the chemicals market. It's been flooded by the likes of China, which has all this excess capacity that they've just gone into markets that they weren't in before because they can't sell it at home because they're, uneconomic producers of the stuff. And then I was looking at the results. The fuels division actually made quite a decent earnings. That was up quite substantially year on year. But I guess the fear is that that's not going to be sustainable. So for both of you, would Sasol be a no-go at this point? Nick?
Yeah, I wouldn't be particularly interested.
Alex?
Almost at any price, unfortunately, just because of the points that Alex has kind of mentioned. So it's just a company that is gonna have a tough next 10 years. And in that environment, you've got to decide why you would then want to hold it, specifically with a company that has a history of a lack of execution, and currently in an environment that's difficult and challenging. So it's going to be tough.
Okay.
Yeah, concur. Over the last year, we've been net sellers, and haven't been buying since. Certainly not constructive yet.
Yeah. Okay. Sure. That is quite an about turn for a company that was a pillar of share portfolios for most pension funds in this country for a long time. Maybe on that note, there's a viewer who sent in a question saying, do your guests think that asset managers' primary focus should be their clients' interests rather than their own? Well, I think we can answer that question, but he says, a reviewer here, all-weather asset managers plea that the offshore investment limits be decreased. So, okay. Nick, what do you make of that? Do you think they should be decreased, or do you think that's actually, it's not good for anyone if you're restricting people in their ability to invest globally?
Well, I think if you look at it from a, let's say, economic standpoint and then an investment offering standpoint, South Africa does not screen well across either of those two sort of metrics. Now, arguably, there is one way that you can, elevate values and get interest back into a local market, and that is by forcing local pension funds, etc., to actually allocate more of their funds into a South African kind of context. Is it good? Well, I'll tell you what, I think it would be good in that environment for equities in the short to medium term. I think they are depressed, they are cheap, and that provides you with a natural buyer. So that's the upside. Ultimately, that could be good then for, I suppose, South Africa and maybe some South African growth. Is it long-term the right sort of idea? I suppose it's like protectionism just in general. I'm not sure it has really long-term structural benefits. I think you've got to rather fix the structural problems opposed to put a Band-Aid over the issues. And this would be akin to putting Band over the issues. I suppose the big argument here is whether, the Band-Aid is on a slight sore or a festering wound or something where you're going to bleed out very quickly. Because if you need to bleed out, then we've got to sort out fixing that immediately and forget about the structural stuff. I don't think we're there yet, but I can understand perhaps the sentiment, or at least the advantage of that sort of sentiment.
Yeah, Alex, what would you say to that viewer? I mean, clearly your client has got to be your primary focus, right?
But the change in Regulator 28 has had a decimating impact on South African fund management. And we've seen massive outflows in the market. And at the same time, foreigners also have sold about R1 trillion of South African equity over the last 10 years. So it's just no more marginal buyer. I guess that, I don't know exactly what the comment was about, but I think most likely it touches on that there's no marginal buyer and we need some money to invest because our market is cheap. But as we know, cheap for valid reasons. I think more flexibility for investors is certainly better. I think we need to deserve and get the trust back from investors by actually running the economy properly and then getting economic growth. Investors will come back naturally, as to forcing them to buy. We also see articles at the moment about prescribed assets and all of these. That's very negative for investors' retirement plans. So I will certainly not be in support of that.
Yeah. Okay. Then, sort of on that theme, a viewer sent quite a nice question asking about considering the structural constraints of South Africa and most other emerging markets. He says, would it be prudent to limit equity exposure to emerging markets and mainly consider bond exposure? And the viewers set kind of a portfolio below as follows, which would be South African bond exposure, limited equities in South Africa, Richemont and the like, he says, S&P 500 ETF, a Euro Stocks ETF, an ASX 200 ETF, that's Australian exchange, and REIT exposure in a tax-free savings account. Nick, what do you think of that kind of compilation of assets?
Yeah, so I think, you reduce your risk somewhat by going into emerging market debt and correlating that with offshore equities. Again, historically, if you just look historically, and there's no there's no definite that just what you've seen in the past is going to take place in the future, but looking at the past and going through that, there is a smaller correlation and a low correlation between emerging market debt and US, or let's say developed market debt, whereas there's quite a strong correlation between the equity markets. And in that sort of environment, and if you were trying to play a sort of a balanced type of portfolio, there are benefits from a risk-adjusted return basis to having emerging market debt, and here proxy South African debt, and pairing that up with offshore developed market equity.
Alex, what do you think of that approach to investing? And do you think it's the correct one? And also if your offshore equity is S&P 500, Euro Stocks, the Australian market, interestingly, and then REIT exposure. Do you think that's quite a balanced mix?
Yeah, it seems solid. One thing I would want to highlight there is that even if you don't want to buy South African equity, I think emerging market equity is quite cheap relative to developed markets, actually at more than 2-decade lows. So to ignore that completely, I think is a bit of a risk. So you can perhaps say, okay, I'm not going to buy SA, but perhaps look at other emerging market opportunities. There's quite a few of those. And you can also make a double whammy where you can see perhaps those currencies appreciate relative to the dollar, and at the same time also market gain. So yeah, I think don't dismiss that as a class being considered as well, but perhaps just manage it in line with your SA exposure.
And the bond exposure, the theory about having emerging market debt, is it because it's high yields, because it is riskier, but the yields compensate you adequately?
Yeah, I guess, but you still have to play perhaps lower duration. I mean, you don't necessarily want to take longer duration if there's credit risk concerns. So certainly in South Africa, you can make some quite good yields at the low end of the market. So yeah, I think that's not a bad strategy if you want to play the yield pickup, but just be cognizant that currency movements can have quite an instrumental impact. And of course, we're all still at the mercy of what happens in the US from a bond market perspective.
Okay. And then a quick question.
Juliet?
Yeah, sorry, Nick.
Sorry, if I could just add to that. I mean, it's just something I've noticed with a lot of conversations over the last couple of years is you talk a sort of a market proxy, right? So the S&P, or you take the Euro stocks, or you take South Africa. The reality is that most emerging markets are correlated to certain industries and certain shares. They're highly concentrated. It's not just a great diversified, aggregate of different assets. And what we're seeing in developed markets is something a little bit more akin to that as well. So you can say that the S&P 500 has performed incredibly well. In reality, it's been largely in stocks and sort of industry that you don't find in many other emerging markets.
Yeah.
A lot of emerging market sort of exposure is going to be more basic material orientated, etc. And so you do go in cycles, and there's always a risk of, just factoring them together and saying, well, yeah, it's just Australia, exposure or American exposure. The reality is they're made up of different sectors, and one needs to drill down to that little bit of level, because that's what's going to drive ultimately the index.
And I mean, look at the S&P 500. It is just a handful of shares, and now it's almost just one share taking you, taking you to where you have gone in the last year. I mean, that was also a real conundrum if you're buying an ETF, isn't it?
Yes, and unfortunately, we've seen a lot of stats, a lot more passive money coming into markets, so ETF type of investing, and the problem is that does create a bit of momentum in these shares that continue to do really well. So irrespective, and listen, I'm not a bear on Nvidia, so I will say that, but just because of the wall of money coming in with these sort of conversations, the S&P 500, the reweighting within Nvidia as an example, it means there's a natural buyer for those sort of stocks, irrespective of or away from valuation, and that is also in itself risky.
Yeah. Just maybe a link to that. A viewer says, which South African stocks look too cheap or undervalued and could rise quickly in the short term? Alex, if you wanted to make a quick buck, where would you put your money?
Sure, there's quite a few in South Africa. I think, unfortunately, most of those are in the small cap space, so liquidity is very poor. And if we do see a down cycle in the markets, it's going to take a while for it to recover. But certainly, if you're willing to buy and hold, when I think about business on top of hand, something like a Caxton, very, very cheap, Capital Appreciation, Lewis, Mustec, there's a lot of these stocks that I think are incredibly cheap. From a larger perspective, the banks, I think kind of like an upsell for me still screams quite attractive. Remgro, so if you want to take a bit of a punt, which is a bit more risky on the telecom side, at some stage, I think MTN gets interesting as well. So there are quite a few options to consider, but I don't think you're necessarily going to make a quick buck. You need sentiment to change to South Africa, and also we're going to have election, of course, end of May, and then also interest rates most likely going to start coming down in the second half. So I think there's going to be a bit of delay before you can see some form of reaction in our markets.
Nick, is there anything that you would add to that list of potential shares, with a caveat that you might not make a quick return?
Yeah, so I suppose it's what is the catalyst for the quick return? I'll tell you what, the companies I'd pretty much be sticking away from and have stuck away from for some time would be the companies turning around. I think it's a difficult environment to be doing a sort of turnaround. And yes, there is a lot of upside if things go right, but there's also inherently a lot of risk. And for me at the moment, if you have a look at the South African market, I would rather phrase it the other way and say what's expensive, and there ain't much. So everything is actually pretty cheap at the moment. I think there is significant upside across many things. Don't know quite a lot what the timing is. Don't know what exactly the catalyst is going to be. But I would prefer to stay in sort of strong, solid companies that, in my view, offer a lot of value at the moment of these levels.
Can you name a couple, or should we wait for your stock pick at the end of the show?
Wait for my stock pick at the end of the...
Ooh, the cliffhanger. Okay. What about Grindrod? And the viewer says, given the woes at Transnet, what are the panel's views on Grindrod as a hedge, given its thriving activity out of the Maputo ports? Now, they've talked about Grindrod shipping, but it would be Grindrod Limited, I think, that they're thinking about. Grindrod Limited is the port operator. And the viewer says, surely our government's loss is there again. Yes, I think so. Alex, Grindrod Limited has actually had a really strong couple of years on the JSE.
Agreed, and for exactly for those reasons. I mean, so they're doing particularly well in rail freight as well as the ports and terminals business. If you look at ports and terminals valuations globally in dollars, it is very, very expensive, very valuable. So if you look at it in what Grindrod is valued at, you can make an argument that Grindrod actually looks quite attractive still from a takeover perspective and so forth. But certainly we think if there's going to be a privatization in Transnet, in either the rail or ports, you imagine that something like Grindrod will benefit to some extent. There will, of course, many other players and the likes, but I mean, they are competing against a Transnet, which is currently, in a shambles. So, and overall logistics as well. And Grindrod got a couple of non-core assets which they can still sell. So we've been investing quite aggressively in Grindrod over the last, call it 12 to 18 months, and we're very happy to hold.
Nick, what's your feeling towards Grindrod?
I suppose, I mean, looking at it now, I think most of the easy money has kind of been made. So I think it's kind of in the valuation to a large extent. In order to it to continue to be successful, you need Transnet's woes to just continue. This malaise that you see, we talk about it, we see it, and it just kind of gets worse and drags on. And ultimately, they continue and remain being this beneficiary. But certainly, they've been a significant beneficiary. And I suppose my worry would be it's almost back to a COVID reopening, or let's say COVID, and you saw the e-commerce players do very nicely. I always think there's only a certain amount of time before things start to change. And in that sort of environment, I think they've had the strong benefit. Not to say that their business is going to go to zero or anything along those sort of lines, but I think the easy money from a risk return kind of basis, for me, it's starting to look a little bit more foolish.
Okay, all right. And then in Bidvest versus Bidcorp, viewer says, I invested in Bidvest 6 months ago because of its lower PE and high dividend, but misjudged that its earnings and price performance would not match that of Bidcorp. So I sold my Bidvest and I bought Bidcorp. Is it a good move or not? Alex, what would you have done in that situation?
Firstly, I want to understand that Bidcorp will probably always have a higher multiple than Bidvest. Most of the business, of course, is in offshore, so it's got low cost of capital. Margins are higher returns, etc. So it is fundamentally a higher PE business compared to Bidvest. And obviously, it's a very global business. They continue to make small bolt-on acquisitions, and most likely will continue to grow, in dollar terms, which of course makes it quite attractive for South African investors. Bidvest still got a big SA portfolio, and they're trying to invest quite aggressively overseas, specifically in the UK. I do have some reservations about some of those deals. Balance sheets also perhaps not where I want it to be. So on a relative basis, I'll probably say I have a preference for Bidcorp over Bidvest, but I'm certainly not negative towards Bidvest. So I think probably made the right decision.
Nick, I mean, your thoughts on whether, do you think Bidcorp might plateau out and Bidvest is going to be the company that surprises? Or do you think the smart money is still in Bidcorp?
No, not really. I think the smart money is in Bidcorp. I think that's true. I would say that it just comes down to the structural nature and the opportunity set of the companies, and I prefer that within Bidcorp. I think Bidvest is much more of a boring company, incredibly well managed. I think they do a great job, but it's not a sexy company. The chances that it suddenly grows at double digits, strong double digits, I think it's much more correlated to your SA economic sort of growth, and then obviously some of the UK. And in that, it's not particularly sexy. I think when it gets cheap, it's because of the way they manage the company and the metrics that they kind of look for. It is a solid company. You really want to get it when it's cheap. And slightly opposite to Bidcorp, which I think is a lot more sexier, which is why it'll trade on higher sort of multiples, better opportunity set, I think. But overall, because of that growth sort of metric and where the assets are priced at the moment, I probably have preference for Bidcorp over Bidvest, although I like Bidvest.
Okay. Then here's an interesting question. The viewer says, my daughter would like to invest 4,000 Rand, which is her expected intake for her upcoming 14th birthday on the 3rd of March. That sounds like a very healthy intake. I'd like to help her pick 4 to 5 shares across a variety of sectors to invest and follow, and also teach her about the stock market. I was thinking of Northam Platinum to cover the mining sector. Could you please advise me or on 4 other local shares or ETFs. Okay, Alex, firstly, would you pick Northam as your mining share?
Well, mining stocks are in general quite difficult. My stock pick actually does have some mining component in it, so perhaps I'll touch a little bit more on that one. But I think if you do choose a single commodity stock like Northam, it's probably a better place to start than perhaps a diversified miner. It's just a bit easier to understand, but doesn't necessarily a better investment. Obviously, you've got very big cyclical swings in single commodities, and at the moment, PGMs are up against it. So it's a tough time, but Northam is growing production. They are, the assets are relatively better than some of the others in the market, but in general, I'm not particularly constructive of PGMs. So if you're a bit more bearish PGMs, my preference is for something like Amplats. And if you're bullish on PGMs, I probably would go for Northam or Impala.
And the 4 others, if you had to, or is it 4,000 rand? It's a lot of money to a 14-year-old. But I mean, just in terms of your stock market investments, do you think maybe you'd be spreading yourself too thin if you had to pick 4 or 5 other shares?
It's difficult at 4,000 rand to have many different shares, but if you want to do this for educational purposes or for, then you want to have a different, spectrum of stocks. Perhaps a retailer, for example, would help, something like a ShopRite, something that the person can relate to, for example. And then perhaps, something like a bank or insurance company. So you want to have a bit to force you on a property company. So that forces you to read a little bit more and learn about different companies and sectors. But if it's more of investment purposes, then I also suggest you look at a global ETF as well. Just get a rand hedge and some diversification, and some risk to the stock picking you might have. You only choose 4 stocks.
Nick, how would you sort of split that money?
Well, I think I must be honest. There's 2 things I would look at. So the one would be the education component. The second component would be I want a company that hopefully can still be around and doing pretty well and has an opportunity set in the next 30 years. Not to say that it will, but it's got a long investment sort of time frame. So taking on board both of those sort of 2 aspects, I'd probably look at a couple of South African assets that is utilized. So invest in the bank that she has an account with. Invest in a ShopRite, invest in a Mr. Price as an example, so you can visually see it and experience what's actually happening there, and there's some sort of education. And on top of that, to be honest, I'd be adding 1 or 2 global stocks in there, and very much having a look at the type of perhaps internet or technology stocks that she interacts with. So tough to invest in TikTok, but perhaps you can invest in Meta for their sort of things, or Instagram, or whatever the case may be. So have a look at that. Have a look at phones. You've got a Samsung, you've got a Apple phone, or whatever the case is. Have a look there, because I think the education is very relatable at that sort of point, and I still think there's probably opportunity for upside as well.
Yeah. Okay. Thanks, gents. And then getting to your stock picks, Nick, I'll stick with you. You gave us a little bit of teaser, so what are you going for this evening?
Teaser. Well, to be fair, I'm not the first to mention it tonight, but my stock pick is going to be in the banking side, and it's going to be ABSA. So I suppose I've been fairly disappointed with the reaction from the Rand post the budget. I thought the budget, it's a very tough sort of job as such, but I thought it was a pretty credible, if not uninspiring, budget. And in that sort of environment, I wouldn't have expected the Rand to sell off, to the extent that perhaps it has. It does make me somewhat nervous, and pairing that with valuations on your sort of more offshore type of companies. And, just having a look at your forward multiple and an ABSA at the moment, less than 6, I think it's incredibly inexpensive. So I think there's a lot of opportunity there. Yes. There's uncertainty of our macro sort of turnaround, etc. But overall, strong, solid, generates a fair amount of cash flow, etc. And the valuation looks attractive. So that'll be my stock pick this evening.
Okay, great. Alex, how about you?
Yes, I'm going for Afrimat. And they had a pre-close update. I think it was last week. I don't even recall. It was okay. It was quite good. Mostly ticking the boxes. The share price has been down about almost 6% the last month, which I think is not necessarily justified. So they've got obviously big exposure to iron ore as well as anthracite for Nkomati mine, which is ramping up. Also got industrial metals in there as well as construction materials. And I think as a basket, they're going to do quite well going forward. I think they've got a very strong management team. They've got very good capital allocation record. And of course, they're still busy with the Lafarge deal, which seems quite likely that's going to go through from their side. There might be one or two issues from a competition commission perspective, but if that deal does go through without punitive conditions, I think AfriMed is, for me, very well positioned over medium to long term. And if I have to choose one particular stock in the SA mining perspective, I think that's one exciting company that I like, and I think the viewers should invest in.
Yeah. Okay, gents, we shall leave it there. Thank you very much for your insight this evening. Much appreciated. Alex Duys is from Umthombo Wealth. Nick Crail is from FNB Wealth and Investments. And up next, the close. Stay with us.